Welcome everyone to the episode of Financial 15. Credit scores, big topic, lots of information. We're going to dive into that today. Talk about some explaining what credit scores are in Canada, how they're calculated, lots of good information. You definitely want to stick around.
Yes, inflation being there, rising interest rates, people worried about whether they can get a mortgage, how much credit they're going to put on there. Everybody wants to know whether they qualify for good credit or bad credit. So we want to talk about the credit scores and the bureaus and the way they work. So if you want to find this video or any of our other Financial 15s, please subscribe to our YouTube channel. Quick and simple, click the button, you're on there, or like us on Facebook. And most importantly, please visit our website at beckerorr.com. Lots of great content there, blogs, events, as well as the videos we've got for there. But today we are dealing with credit scores in Canada. And exactly what are they? Most people know that term exists, but they have no idea what the numbers are, how this bureau goes, everything else along those lines. So we want to give you sort of that high level, quick explanation. So Clint, why don't you start us off? What are we dealing with when we're talking about credit scores?
Yeah, we have to differentiate between a credit report and a credit score. Lots of terminology here, so we're going to have to do a little bit of semantics. Dig in first off with that credit report, which, as it name implies, is the summary of your credit history. So it's a file, it's a report that has all the details of your actual credit history. So the credit reports are created when you borrow money, you apply for credit for the first time. Lenders are going to be sending information to the credit bureaus. All of that goes into your report, and that's different, Kevin. That credit report is different than your credit score, right?
Yeah, and the credit score is basically that 3-digit number that everybody quotes, or 750, is it 640, is it 300, whatever the case may be. That is the one that comes from the information in your credit report. They put all these things together and they give you a 3-digit number. And that 3-digit number basically tells you how well you've managed credit and how risky you are for a lender. So the higher the number is, usually the better off you are. Your credit's been good. You've got a history that proves that. The lower the number, maybe you don't have a credit history yet. Maybe there's other things to deal with. Somewhere in between, that's how one of the factors would be on how lenders deal with you going forward. They need to know what your credit score is to sort of give an evaluation as to how they think you're going to be able to handle credit going forward.
Yeah, and they look at more than just the credit score. So if a bank or credit union apply for mortgage, they won't base it solely on that credit score. There'll be other pieces of information like your job history, your income. There'll be other things that matter that are part of that overall profile. But the credit score is certainly one of the pieces of information. So worthwhile to understand the details there. And we'll get into a few of those details. We mentioned the credit bureaus, right? They're sending this information, the banks and credit union, to the credit bureau. The credit bureau has the report. They're the ones that create the score. So what are the credit bureaus? There's two big ones in Canada, TransUnion and Equifax. Those are the two big ones. Those are actually private companies. They're collecting the information from the creditors. So they're getting them from the banks, from the credit unions, all your financial experiences in Canada. They're storing the credit report. And most importantly, they're the ones calculating your credit score. Now, to make things more confusing, we're talking like as if there's one number, there's one credit number. That's not the case. Equifax and TransUnion, both of them have multiple credit models. So with Equifax, you could actually have more than one credit score, and the models aren't the same. So your Equifax number and your TransUnion number aren't necessarily identical. Now, some of the driving forces are the same, but I wouldn't get too hung up on the specific score because each bureau has different methodology, and each bureau has more than one way to calculate the score. So you could actually end up with a couple of credit scores from these different credit bureaus. Is that confusing enough for you, Kevin?
Yeah, exactly. I mean, why not make it simple and just give you one number? No, we're going to give you a few different numbers. Now, again, they're not going to be vastly different. You're not going to get one at 300 and one at 760. Yeah. You're probably going to get things that are close to the same area, but they could be different. But again, when you get your credit score, again, as we mentioned, where that number lies between 300 and 900 definitely tells what kind of credit history you've had. So again, no magic number, as we've mentioned, but what's considered a good score by lenders is something that you need to know. So, I mean, if we just take a look in the middle, good is basically 660 to 724. Those are the numbers that you try to shoot for. Anytime you get that, a lot of people will take a look at things. As Clint mentioned before, this number is not the only thing that lenders look at, but it is definitely one of the main qualifying aspects that you need to do. So as we can see, if you're on the bottom end, which is basically, 300 to 559, you're in poor quality. That may have a very bad effect on you. Whereas if you're over 760, you're considered to be an excellent credit risk. And chances are that will help out along with all the other aspects that you have to get your credit. But realize that where your credit score is does have an influence on what's going to go forward with you. You always want to try and improve that credit score. And again, if you're set with one right at the beginning, it doesn't mean it's going to stay that way for the rest of your life. You can improve your credit. By the same token, if you miss payments, you can also make your credit worse going forward.
Yeah, and 660 and above, so if you're in that good category or higher, you probably don't have any trouble getting debt. Unless you're applying for 17 mortgages, you probably get any debt that you request. So if you're 660 or above, you're likely in a good spot when it comes to lending. And this is a general rule. Again, don't get too hung up. Oh, my number is exactly 559, or I'm above or below. Kind of a general guide here. And important to keep in mind, I mentioned the two credit bureaus. The reason they have kind of different scores, part of it is not all the information is sent to each one. So sometimes a bank might only send information to one credit bureau and not the other. So they might not have the same information in their file. That's part of it. But we're going to go through, give people some context here, Kevin, see where they might fall according to other Canadians. And first off here is from Borrowell, and they're looking at the average Canadian credit score. They've done this for a couple of years. In 2020, it was 649. In 2021, it bumped up to 667. You can see in 2022, it inched even higher. So the average Canadian credit score has been increased in the last couple of years. According to Borrowell, in 2022, that average credit score is now at 672. So it's in that good category. That's the average in Canada. That's probably some good news.
Yeah, we've moved from that sort of fair area back in 2020. And again, it's pandemic oriented and things like that, to a little bit more stable scenario of being good by the time we get to 2022. Will that continue going forward? Again, it's going to depend on what interest rates do, where monies are, and everything else. But if we break this down a little further and just take a look sort of at cities, major centers in Canada, you'll see that depending on where you live, seems to have had a better effect as to what kind of credit you've had. So if you're sort of in that BC, Burnaby, or Markham area, you're 700 plus. That's been the average credit score. Again, larger mortgages that some of these people have to have. So you may have to save a little more money to be able to get down payments and things along those lines to be able to do it. So that could explain a lot of your good credit. Whereas you start looking at the bottom end, sort of the Saskatoons, Edmontons, and Monktons, yeah, they're considered fair. They're not vastly fair or that short under good. But again, it may be just where the area location is that you're not, utilizing the same sort of credit scenarios. You may not need as much going forward. But again, this is, as you can see, it will move up and down over the course of the map. And it's not geographically destination. So, I mean, Markham's in the east, BC's in the west, and the same thing on the other side. Moncton's in the east, Edmonton's in the west. So again, there's no sort of generalization there. It just happens to be where it goes.
And this information is from Borrowell as well.
Yes.
So both the past two slides, and this is 2022 numbers. So in a couple of years, it obviously could change, right? These are not set in stone. Last bit of data here from Equifax, this data from Equifax Canada, and it just breaks down the average credit score in Canada by age. And it's probably what you'd expect, that the numbers increase with age. So you can see that 18 to 25 category is still a decent credit score, but the lowest of the age groupings. And then as you get to that 65 plus category, most people are in that excellent category. They're kind of 750 or higher, which would make sense, right? And we'll talk about what makes up the credit score and a history in a moment, but your credit history is part of that. So if you have a number of years where you're paying the bills on time, that bodes well for your credit score. And you can't do that when you're only 20, right? You need a bit of time and experience in order to build that up. So it makes sense that on average, older Canadians would have better credit scores than younger Canadians.
Yeah, that goes without saying. You're right in that aspect. The longer you go, the more chance you have to increase your credit score from the lower end into the higher end. Because, yeah, I mean, if, as you mentioned, you're 20, chances are you've only had 2 years as of being legal to be able to qualify for credit. So you can't automatically just build it tomorrow. So odds and ends that have to be looked at going forward. But yeah, again, sources Equifax that we've used for this, and that's definitely one area that we can look at.
Yeah, and we'll dive into a credit model here. I mentioned there's a couple of models and there's a few different scores, but we'll try to simplify here. This is a general model. This is from Equifax.ca, and it provides some of the information they look at. So it looks at 5 different categories, and you can see the weightings there. They're not weighted equally. Payment history and the amount of credit you use compared to the amount of credit you have available. Those are by far the heavier weighted categories. That's about 2/3 of the overall score just between those two. And then the other 3 categories make up that final third. So we'll break it down here, explain kind of what goes into that credit score. So the first category here, Kevin, this is the big one. This is payment history, right? It makes up about 35% of the overall score.
Yeah, I mean, and that's a big factor. I mean, the easiest way to tell if somebody's good with their credit is, do you pay your credit constantly on time? I mean, if you get a Visa bill and you're paying it late every single month, that's going to be a detriment to people. All of a sudden, you have a certain time frame to pay this thing. If you're not doing it, the more missed payments you have, that's going to lower your credit rating down. And that's a huge factor, because the biggest factor that a lot of the financial institutions will look at is, can they get their money paid to them on time? And if they can't, that becomes something that they're going to look at going forward. So details of late or missed payments, how often you miss a payment, how much you're missing the payment by, these are all big factors. And that leads, of course, to the second one, which is your used credit versus your available credit. And again, if we take a look at that, just using, say, a Visa card for an example, if you have a $20,000 limit and you put $1,000 on it, you pay it off fairly regularly, everybody's going to be fine with that. Whereas if you're the opposite way, you've got 20,000 on it and you're just barely making the minimum payment, you're constantly late on it, well, all of a sudden, we don't trust that we can give you any more money, because we don't know that things are going to change. So as it says, how much of the credit available is being used on lines of credit, credit cards, also the maximum that you could charge against those credit cards. Those are two very important factors, significantly compared to the other ones.
Yeah, and important to mention, they're looking generally for patterns. So if you miss one payment, your payment history is not shot. It's just if it becomes a regular occurrence, that's really what they're looking for. And same thing with used credit versus available credit. If you max out your credit card once and then pay it off, not the end of the world. But if you're continually pushing it to the max, well, that's probably going to flag in this category and impact the credit score. Look at some of the others here into credit history. And the simple item here is longer is better. This relates back to, we talked about the older Canadians have a better credit score. This would be part of the reason why. They just simply want to look at how long you've had credit and if you've been able to keep it in good standing. So what they'll look at is the longer, your oldest and your most recent credit accounts, the one that's been open the longest and the most recent one. That'll give them a good idea of the overall history, and longer is better is really the idea there. They want someone with a long track record so they can properly evaluate the credit risk. And then public records, that's only 10% of the weighting according to this particular model. And that's really anything that they can get through that's available in the public that could impact their view, right? So bankruptcy, collection issues, all of that is obviously negative when it comes to credit worthiness. And that'd be something that'd be available in the public record that they would pull in. Exactly. That would have a negative impact on your credit score. So that's 4 of the categories here, Kevin. I'll let you cover the 5th one. And this is a common question. People say, well, I checked my credit score. Does the fact of checking your credit score actually impact the credit score?
Well, again, that's not a question that's easily answerable, right? I mean, it all depends on, as we've listed here, a hard inquiry or a soft inquiry. So again, the hard inquiries those are the ones that impact your credit score. Now, they're related to seeking active credit. So if you're applying for a new loan, if you're applying for a credit card, and they have to do a credit check on you, these are what are known as hard inquiries. So the more of those you do, that is going to affect your credit score, because they're going to want to know, I mean, if you're doing 7 or 8 hard inquiries a year, why? How much credit do you really need, and how much credit are we actually giving you? Those can be something to deal with. But if it's your own request for filing your credit file, or it's a pre-approved credit card, that's what's known as a soft inquiry. And those basically, they do not add up into your credit inquiries, because you're really not doing the same sort of hard impact that you want. You're just trying to find a few odds and ends out here and there, because it doesn't say that you're applying for credit immediately, but you just want to know where you are in case that comes down the road. So whether it's a hard or soft inquiry, that's going to have a difference on what goes on.
Absolutely. Hard inquiries could impact the score. Soft inquiries would not impact the score. That's really the takeaway there. So there's a lot of information, and we're just trying to explain credit scores. We'll probably do a few more videos diving into other angles related to credit. But if you have questions for us, get a hold of us, chatwithclintonkevin.com. We would certainly love to hear from you, tackle any questions you might have. Anything you want to say to the folks before we sign off, Kevin?
No, I think we've covered the credit score thing on a high level now, but as you mentioned, there will be more credit score videos, and let's hope that your credit score is always good.
Sounds good. Take care.